Hello and welcome to Options in Plain English. Today we're going to talk about the expected price range based on implied volatility. We talked already about implied volatility. We know that it's expressed in annualized percentage points. So for example, 15%, 30%, etc. We know that it comes from option prices. So it's not something that we measured in the past, but it's rather something that is being traded right now and information that can be obtained from actual option prices. And we know that it represents a plus or minus one standard deviation price move in 1 year. So if we have an implied volatility of 20%, we know that the price in a year is going to be in a range between the price currently in the market plus 20% and the price currently in the market minus 20%. So 68% of the time, because we're talking about the normal distribution, the our outcome is going to be in between that range. So basically, the price minus the price times the implied volatility, and the price plus the price times implied volatility. But what will happen if instead of 1 year, which is the number that you can easily get just by looking at the implied volatility, we wanted to know what's going to happen in periods that are different than 1 year, which is going to be most of the time. We're going to be wanting to know the price range that's going to be in this 68% range, but not in 1 year. You might want to know what's going to happen in 2 weeks, in a month, in 1 week, in 6 months, etc. So how can we adjust the formula so that we know a valid price range based on current option prices using their implied volatility to estimate the potential price ranges that could be where the price could lie a certain time from now. So let's say you have this is a price chart of a stock, and we're going to analyze what's going to happen in this time where we don't know what's going to happen, but we have the implied volatility and we have a certain time. So we have an initial time and a final time, which is altogether, we're going to call it time. And you have the implied volatility acting on the stock during this period. So what we want to know is what's going to be the range for it. So let's start talking about a little bit about the formulas that we already know. So we talked about in the past about variance, and we know that implied volatility is the square root of variance, and because of this, variance is equal to the squared implied volatility. And we also mentioned in a previous lesson that variance is proportional to time. So if you have a certain period where variance is acting, half of the time, if you take half of the time, then you're going to experience half the variance. So it's proportional. It's directly related to it. So if we take the square root of both these terms, so square root of variance, square root of time, and we know that the square root of variance is the implied volatility, we can see that the implied volatility is directly proportional to the square root of time. And this is very important to know this, that implied volatility is not distributed evenly across time. It is distributed evenly across the square root of time. Variance is the one that's distributed evenly. So the implied volatility for a certain period is going to be equal to the annualized implied volatility multiplied by the square root of time. Now that we know that we have the IV for that particular period, we don't need to use the annualized anymore. we actually have to plug this value into this formula. So it would be the price range for any period is going to be equal to the price, the current price in the market, the stock price, plus or minus the price multiplied by the implied volatility that's annualized, multiplied by the square root of time, expressed as a percentage or as a fraction of 1 year, because the IV is expressed in annualized form. So if we want to just simplify it a little bit, we can see that the price range that is going to contain the 68% of all occurrences in the future is going to be equal to the price plus and minus the same price multiplied by IV and multiplied by the square root of the number of days divided by 365. Now, some traders here use a different number than 365. They use, for example, the number of business days in a year. So they would use 252. In this case, I've always used, and most of the traders that I've worked with use every day of the year, because most of those quantities that we're expressing in annualized terms change even though it might not be a business day. So in this case, from now on, I'm going to be referring to 365 days, but you might want to use a different number of days in a year, and if you want, you could use 252. So from this point on, just know that when I use 365, you might want to use a different number, such as 252. So we have the value for the expected one standard deviation move, which would be equal to the price, the current stock price, multiplied by the implied volatility in annualized form, multiplied by the square root of number of days, divided by 365. So if you use 365 days, for example, then you would be getting the square root of 1, which is 1. So basically, this would be what's going to happen in 1 year. So, and this is a way to easily calculate with this formula what the price range is going to be for whatever period that you select in the future using the current implied volatility, which is obtained from option prices. So it's a very good way to get a sense for where the stock price is going to be based on information that is currently in the market. So we're not using the past, we're not using historical volatility, we're using the current information that is being traded in the market to obtain an implied volatility that determines a certain range of prices in the future. So now we're going to do an example here so that we can see how to use this formula and how to determine the price range in the future for a certain stock, if we know what its implied volatility is. So we have an example of a stock that's trading at $100, which has an implied volatility of 30%, and we're going to figure out what the range is going to be in the next 180 days. So stock is trading at 100 with a 30% implied volatility, and we're going to calculate the value for 180 days. So just about half a year. So we have the formula here, the expected one standard deviation move, which is plus minus the price multiplied by IV multiplied by the number of days divided by 365, square root of that. And we just plug in the numbers, and it's going to be 100 times 0.30, which is the IV in percentage terms, and then the square root of 180 divided by 365. So we're going to get, by using this formula, a value of $21.06. So what does this mean? Well, it means that from the price that we currently have, which is $100, $21 higher and $21 lower would be the range that is going to contain 68% of all occurrences in the future. We don't know what the future is gonna have. What we don't know we don't know what's gonna happen in the future, but we do know that we have a 68% probability of this stock price value landing in a range between, in this case, it would be 78.94 and 121.06. Okay, so now we have the range, which is 78.94 to 121.06, and it's easy to use. The formula is very easy to use. Just plug the numbers into it, and you get the range. And based on this, you might want to adjust your strategies, or to modify your strategies, so that you know that you're targeting a price that is actually not only possible but probable. So this is how the formula is used, and you can see how easy it is. And this is the formula that you're going to be using most of the time to determine the ranges. We've already seen the formula that we're going to be using. However, in this section, I'm going to be talking about a more accurate version of this same formula. And this is one that uses advanced statistics to figure out the actual price range for the distribution of stock prices. Now, it's going to be a little bit more complex, and it doesn't necessarily differ a lot from the formula that we already saw. So I'm going to include this here as a reference. So if you don't want to use it, don't use it. The formula that we already obtained is more than enough, but I wanted to put this here so that you guys can have it as a reference. Okay, so we talked about implied volatility in annualized percentage points, and we know that it represents the plus minus one standard deviation price move in 1 year. But what would happen if we had a stock that has an implied volatility of 200%? So in this case, of course, the stock could go to $300. For example, if the stock was trading at $100 and had an implied volatility of 200%, it means that after 1 year, the stock could go to 300. And could it go to minus 100 because it's $100 minus $200 because of the minus 200%? Could that happen? Can we have negative stock prices? Well, of course, we don't have negative stock prices. Because of this, the distribution of stock prices is said to be not normal but lognormal, which means that it moves the return of the different changes of prices is distributed in a normal way, in a normal distribution, but the actual prices themselves are distributed lognormally, which means that it can only go down to zero and it can never take negative values, which matches what we see in real life. So therefore, we see that if we want to get technical, the distribution of stock prices is not normal. It's not a normal distribution. It's a lognormal distribution. Okay, so it means that the implied volatility doesn't represent a plus minus one standard deviation price move in 1 year. It represents a plus minus one standard deviation range of return in 1 year, which is a little bit different, because when we talk about returns, we talk about compounding. And when we talk about compounding, we are going to be talking about natural logarithms and also exponential functions. And this is what the formula that we're going to see is going to contain. Now, if we want to start getting technical, let's take a look at the actual formula, which states that the price range is going to be equal to the price multiplied by the constant E, and this E is going to be elevated to the power of R, which is the risk-free interest rate, minus squared IV divided by 2, multiplied by time, plus and minus the IV multiplied by the square root of time. So this is the formula. As you can see, we have the plus minus right here, which indicates that it's going to be a range, which is what we had been talking about before. So let's use an example, the same example that we had before. Stock price equal to 100, implied volatility 30%, and time of 180 days. And we're gonna get the numbers. So we'll plug in these values into the formula, and we get the two boundaries, the lower boundary and the upper boundary. And we have that one is 80.27, the other one is 120.74. Now, if we compare those numbers to the ones we got with the formula that we already used, which is this formula, and the formula that we're going to be using from now on, you can see that it's right here. There's not a lot of difference. So it's not very different from each other. They're not very different from each other. So this is why we don't even bother using this one. So it's good to have it as a reference, and so that you can access it anytime you feel that you need to. But in reality, we're going to be using this formula most of the time. Now, when would we use the other formula, the exponential formula? Well, we would use it in situations where we're talking about either a large period of time or a large implied volatility, or both. So for example, if we were talking about implied volatilities of 200%, etc., then it would be much better to use the exponential formula, just because we're not supposed to have zero value. So got to be careful about that. So anytime you have implied volatility values that are, let's say, over 100%, I would go straight to the exponential formula. Or if we have a long time, then the values are going to start diverging, and the values between the ranges between the difference in ranges between the formula that's the exponential formula and the formula that we're going to use are going to start getting further and further apart. And because of this, it would be better if you were to use the exponential formula. For the most part, we're talking about times of 40 days, 30 days, 50 days, 3 months, 4 months, and implied volatilities of 50%, 60%, 20%. Then you're fine using the simpler formula, the one that's in a rectangle here. So this is what there is to know about this formula. Now you know how to get the price range for a certain stock when you have the implied volatility and the time. And now you're ready to use the formula. So you can take it and you can apply it, and you can modify or adjust your strategy so that they fit whatever it is that you're expecting the market to do, and so that you can profit from it. I hope that this was useful, and I hope that you guys can get as much as you can from it, and I hope to see you guys around next time. Thank you very much. Goodbye.